We are back for another episode of Deal Hunter. My co-pilot, Tom Staub. Always good to see you.
Yes, sir. How are you?
Man, I'm excited to talk about real estate with our next guest, Daniel Belden, who is head of investments at DDelta. He supervises the deployment of capital, project underwriting, and overall due diligence for all investments. Daniel, it's good to have you on. How are you?
I'm doing well. Thank you all for having me. Excited to get this going.
Yeah, we were chatting last week and DDelta doing some very interesting things around the multifamily space, and really would love to just kind of intro you to our listeners about what the thesis is. And before we get there, talk a little bit about your background and some of the things that you're doing on an individual level that essentially helps DDelta's mission.
Sure, absolutely. Well, I've been with the company now for 12 years. So basically all my professional career has been in real estate. And so I've kind of seen how the market and how the industry has really changed over the years. And, I started off in our corporate office. So our company is based in Mexico. That's where we get most of our equity. So it's a little bit of background. DDelta is a private equity firm, and we invest in multifamily deals. So that's in a nutshell. So my career started in our corporate office in Mexico as a market intelligence analyst, and slowly transitioned into the position of investments. We opened the office here in the US right around 10 years ago. And ever since then, yes, it's been mostly overseeing, the deployment of capital, trying to being very vocal with investors, raising capital with investors. Really, it's been a lot of that. And obviously overseeing the deployment with the rest of the investment team. And so it's been quite the ride. And we love, multifamily above other asset classes for, certain demand fundamentals that we will definitely talk about in this next couple of minutes.
Well, are you where are you mostly located? Is there a geo that you have most focus on, or how would you categorize your overall portfolio?
Sure. Yeah, so we've kind of stuck our guns to Texas for a lot of obvious reasons. A lot of net migration coming into the state, a lot of, different employers opening their campuses or expanding their existing campuses. It's mostly been sticking to Texas. We have been looking into other markets recently, like Phoenix, Atlanta, Nashville, Tampa, Orlando, Raleigh, Charlotte. It's kind of call it the Sunbelt region of the US. And, I think we'll probably keep being focused in Texas, but we'll start expanding out of state into those growth markets as well.
So one of the things that we were talking about last week that I found really interesting was when we had first met, most of the multifamily that you were doing was value add, if I'm correct.
Mm-hmm. Yeah,
and
it was a different moment in time for sure.
Sure. And I think really what separates great stewards of capital and these asset managers are the ones that I think are going to have more success are folks who are able to pivot and essentially take what the market gives you. So right now, from what my understanding, you guys are doing more development. Do you think that that's really what you're going to be focused on, or do you still think you might, wherever there might be an opportunity where the valuation looks strong, that you might jump in on a value add?
Yeah, very good question. We love the risk. Just our DNA being a development company in Mexico kind of gives us a little bit of more feeling of being comfortable with taking some development risk in the US. So I think that's somewhat to do with our DNA. But to your point, I think our thesis is really open to doing either or. So we could do either acquisitions or or new development. And yes, we have been sticking more into the new development type of thesis recently, and call it the last 4 or 5 years, just because of the whole how the industry has looked like in this segment, right? There's been lots of liquidity in the marketplace, a lot of capital chasing deals on the exit or in dispositions. And so we've been basically being providers of these types of assets to large private equity firms or REITs. And we feel that there's still, you can still find deals where your cost basis is below replacement costs. So we've been talking, with a bunch of local developers in the state or abroad in other states, and you're still finding those stories. Now they're definitely becoming much more complicated. I mean, as recently as, these last couple of weeks, financing these deals with commercial banks has been a challenge for the industry. So you'll probably see a lot of supply started getting tapered down. And, maybe you start seeing, because of the pressure on interest rates, the cap rates come up, and perhaps seeing some, acquisitions in the marketplace. And so it's to be determined. I think we still like the new development deals. We're still finding some opportunities, but this could change in the next 12 months.
Let me ask Daniel, curious to know how your firm values risk versus maybe a more traditional US based. Now, I noticed that HQ is in Mexico, right? So there's some element of safety of currency and safety of capital by being in the United States. Does that have an implication to your risk tolerance here in the United States, or is it agnostic?
Yeah, no, absolutely, it does. It definitely helps in the fundraising aspect for sure. A lot of our investors, most of them are, high net worth individuals, some wealth management groups. Recently, we did start to do more retail product for certain, like for a private bank in Mexico. So we're starting to get some more and more retail investors, but it definitely is that play, the currency risk adjusted returns. And I think that helps. And it's also helped recently. I was talking to Mitch last week. We've made a couple of trips to South America, namely Chile and Peru, to visit those markets. And, because of the whole social political situation down there with, new populist governments coming in, there's a lot of flight of capital, and, real estate in the US sounds pretty appealing to those types of investors as well. So we've been trying to raise in more capital in South.
We're seeing that. I have a capital raiser partner. We're seeing that in China, and I know Russia as well. There's something like 12,000 millionaires escaping China right now with money. I mean, it's something insane. So
not surprised. I mean, there's definitely still a lot of, liquidity, a lot of money on the sidelines trying to pounce on the right deals. So I think a lot of these players probably were very active in 2021, probably in the early part of 2022. And nowadays, I think there's just waiting for, perhaps rates to start, coming down maybe in the first quarter, second quarter, 2023, who knows? But if that's the case, I think there's going to be a lot of, money pouncing on these deals. So I think we want to be still very active in new development deals and wait for that capital on the exit side.
This would be a good conversation to have. Do you feel, especially, not just Latin America, but overseas, that not just the equity capital in the form of LPs wanting to place, their capital here in the US, but also the debt? And we would welcome the debt because obviously, we know what's going on here, but the debt overseas is far cheaper. And so perhaps there's some spread. Have you guys embarked at all on securing debt in perhaps in Latin America or even overseas in Europe?
Great question. No, we haven't looked into that yet. Most of our financing comes from, local regional banks, commercial banks, for our construction loans, and agency debt for whatever deals we do end up holding longer term. But no, we haven't really looked into that. It's quite an interesting topic. I would assume that maybe a lot of these banks through their local or US subsidiaries might be starting to pour more debt. But I guess it's just to be determined. I haven't started getting into those conversations with banks yet, but I'm happy to do so probably in the next couple of months. In case, in case we start figuring out that it's somewhat impossible to get construction loan financing from here till early first quarter of next year.
To the institutional investors and even the retail investors who see boatloads of multifamily opportunities, whether by local, regional developers out there, what are some of the things that they should be looking for in an operator, in somebody like a DDelta, to perhaps help them sift and differentiate who the actual managers are that can actually deliver superior alpha?
Yeah, very good question, because I think it's to the point where, we've been riding a very good wave these last, 10 years. And, a lot of people have done very well. Some people may be executing under a thesis that's somewhat optimistic, and you start seeing these types of signals in the macroeconomic environment. And once things start getting somewhat difficult, the real operators, the good operators, will start standing out, right, from the ones that were just riding the wave and executing somewhat easy, something that was easy to do, easy to do money with. So that's a good point. Something to be focused on, I would say, is how conservative the underwriting is. There's a lot of, we see a lot of our competitors do very optimistic underwriting or promising certain returns, which I've been unable to see yet with our underwriting. And I think you need to stick with someone who's probably going to be local, knows the market very well, knows how to select projects and create some sort of value proposition on an asset level. I think that'll be important, whether they were able to get, the land cheaper because it was off market, or, they're catering more towards an affordable product versus a more luxury product. I would say would be a better thesis nowadays. And obviously maintaining very conservative capital structure, I would say something that's going to be very important nowadays. A lot of asset managers were over leveraging their projects. I would see a lot of people do, senior loans on 70-75%, then covering 10-15% with mezz debt. And once things start getting difficult and you see that debt was floating, and they'll get into trouble very quickly. And nothing like what happened in 2008, 2009, but you'll still see some hiccups in the industry for sure.
Daniel, hey, question about your actual deals themselves. What's the average size of your project? Maybe slight dive into the timing of your phasing and all of that.
Sure. I would say kind of a fair a deal that's going to ride down the fairway would be a 250 to 350 unit deal. Nowadays, that would cost anywhere between 50 to 80, 90 million. And we usually structure those deals, before, and it's to be determined whether we could still get this, but we would be anywhere between 60 to 65 loan to cost. So, our equity checks on a project level would be, anywhere between, 15 to 30 million in equity. And, we look for perhaps the size of our funds are not huge. For example, we're right at 125 million on our current fund, which we're allocating right now. So we were looking at maybe 4 or 5 deals, right? So that's kind of, we feel that we were able to diversify the portfolio enough with that.
Yep. So you're doing mostly, if I had to guess, 3-4 story garden style apartments, 1,000 square feet, 2 2s,
That's right.
probably on 15, 20 acres apiece.
Yeah, I would say, yeah, I mean, it's a mix between, some garden style deals. And maybe we have one podium deal out of the 5, obviously that being the bigger ticket of all. So anywhere in between, you could do like wrap product or 4-story for surface park. So that's kind of our niche. We usually don't do mid-rise, high-rise. Those are much larger tickets. And, we maintain a policy that, not a single project can be more than 30% of the total equity of our fund. So,
Got it. So, okay, got it. So you're doing, yeah, that's pretty straightforward, at least from my perspective. I assume like everyone else, you're seeing issues with supply, labor. Now that's coming down, I think. labor is getting a little easier.
yeah.
Lumber is finally back to norm. What else are you seeing in terms of execution of the actual construction?
Yeah, it's a world that changed somewhat after COVID. It's buying materials regardless of the situation right now, and it's some easing in the supply chain. We're still wanting to buy out most of our subcontractors, in the first 6 months of the project, right? And that used to be on an ongoing process when the supply chain issue wasn't going on. So we're still doing that. We're also another thing that we're doing is talking to the city of Austin or city of Houston, Dallas. They're having some trouble with getting people on site for inspections. So we need to just plan that accordingly and have enough time budgeted within our models to allow for certain delays. So it's kind of doing that just to mitigate the most amount of risk, to be quite honest with you. As far as risks go, it's construction pricing for sure. You can still see some increases with inflation. So it's buying out early and having the right contingencies in place for construction loan interest reserve and enough time budgeted in case you get some sort of delays with the city on inspections.
Yeah, that's how we're seeing it too in our underwriting. A year and a half ago, we were underwriting in current conditions, and now that's coming down. So to your earlier comment, because our underwriting was conservative, even in the current times at that time, we're now 15% above our costs. Well, I guess below our costs. So it's interesting. Now, again, the top line's coming down a little bit, but it's interesting how this is all boats are kind of going down with the tide.
Right. Yeah, absolutely. And if you underwrote deals, 18 months ago, you would never have thought that, we would have had this run on rent growth on 2020, 2021, and so far 2022. So it's probably very good. It's looking pretty good right now, especially with the cost basis back then too. So right now the challenge will be obviously still we'll be penciling out those deals and with high construction costs and higher costs of financing.
Yep.
With respect to, you mentioned that you guys operate in a few different geos, primarily looking at a lot of the Sunbelt states that I heard out there. How are you identifying the right JV on the ground? Because that's obviously something, you guys obviously have your HQ in Mexico, but you've established yourself as a real player here in the Texas market. So you're familiar with that space.
That's right.
Talk to me about some of those other geos where you may not have direct presence and finding the right partners, and what are those things that you're actually looking for with those partners?
Yeah, well, so for those partners, so first of all, I would say we tend to, whenever we head to a new market, we tend to go with someone we have already executed a deal before, and they might have, already operations in those markets. So I think that's always helpful in order to mitigate the most amount of risk from an execution standpoint. Now, that doesn't mean that, we're open to meeting new local developers that have, long line of experience there. And what we tend to look on those sponsors is, how well aligned their interests are with ours, right? They have to have some skin in the game. We always ask for them putting down maybe 10% of the total equity required for the project. They're guaranteeing the construction loan. Things of that standpoint seem to align interests very well with us. They obviously have to have the right people in place, very well staffed. Reporting is something that we also take a look in, because we obviously have a fiduciary responsibility to our investors, so their reporting has to go in line fairly well with ours. And it's how they're creating value at the end of the day. How are they selecting sites? How do they buy land from that's market value, or they're trying to put this land on a contract, then go through some sort of rezoning or entitlement risk? And I think that's the real way I think a JV should work, and a way that the developer will ultimately be aligned is via their promote structure, and taking that risk before we come in is something that we look into. It's one of the funny things that we saw happen when there was a lot of liquidity in the marketplace was equity players coming in and co-guaranteeing construction loans or providing pre-development expenses capital, and when people start doing that, it's kind of raised a little red flag in my head, and that's when the market is out of sync, and that's not what a stabilized, a good, healthy market should look like. And so I'm looking for sponsors that are heavily invested and go through what a developer should do, and take the amount of risk that they should take, and that aligns interest very well with us.
When you say alignment of interest, it's always about, if you align compensation, you always get a much better result. And so talk about aligning interest from top to bottom when you guys are looking at a specific JV. Obviously, you guys specifically want to have an alignment with your LPs.
That too.
What are some things that a limited partner should be looking for in those the alignment of interest for the GPs that they're working with? What do you think is fair, and perhaps what do you think is unfair, and perhaps some of those red flags that jump out at you potentially to an LP and say, you know what? Yeah, that seems like a pass for me.
Sure. Absolutely. So there has to be, similar to what we ask from our developers, there has to be some sort of big co-invest from a GP standpoint. So for example, what we do is anywhere between 10 to 20% co-invest with our LPs. So it's pretty hefty. I think the benchmark in the industry is right around 1 to 5%. So we're heavy in that regard. So that's one of the things they should definitely take a look at. The co-invest. One other thing is, how active they are on a deal by deal. We act as very active investors. So basically our management fees pay our overhead, right? That's not it's not a center of, profit for us. Our profit really lies in what we call kind of the success fee, right? So after kind of the waterfall with our LPs, after they have their preferred return, and we receive our promote interest until the last asset is sold in our funds. So we don't see a dime of success fee until the last project is successful, and we have at least given them a preferred return, which I think is kind of the European model of private equity, at least on a waterfall perspective. And that aligns interests very well to where kind of the manager or the GP is not incentivized to, sell one asset at a premium and, half-ass the second or third, fourth project because they already won big on the first one, right? So they're not paying closer attention to the execution of the other deal. So I think being compensated until the very end aligns interests very well too. And again, the fees not being a center of profit, that's basically mostly used for overhead, and they have to have a team in place to justify the amount of fees. So when I see a team or GP that, it's three guys overseeing an investment and they're charging, anywhere from 5.5 to 2% fees, and that's a profit center, right? So you have to look at that structure very well.
That is a phenomenal breakdown. I appreciate it. One last question before we let you get out of here. You talked about the preferred rate of return, and obviously that's a component that LPs see, but most of these development deals, the time horizon is probably what, 3 to 5 years, perhaps a little bit longer on the development side.
Sure.
What I'm curious about, more important than the preferred rate of return, is the MOIC. What are you seeing or projecting for investors on that MOIC for that term of investment?
So yeah, good comparison. So for example, for our, 3 to 4 year holds, we've been selling anywhere between 1.5 to 1.8 MOIC. And, for longer term holds, that tends to go up. So call it 5 to 7 or 8 years. I would expect anywhere between 2 to 2.4, 2.5, perhaps. Again, conservative underwriting. It's a different way to see it, because a lot of people, they're very focused on, IRRs or return on cost. That's a big one lately, just because of where construction costs are. So it's something to take a look at too. Besides MOIC, it's kind of what cash flow the project's generating if you were to hold that asset forever, right? So that's an important metric to take a look at too. But MOIC for that length of the period, I would assume hopefully it should be anywhere between 2 to 2.4.
Daniel Belden, head of investments at DDelta. We'd love to have you back on. This was so helpful and informative. And thank you so much for carving out a few minutes today.
Absolutely. Thank you all for having me.
We'll talk to you soon.
Talk soon. Thank you all.
Take care. Tom, it's always interesting to hear from another developer, and these are guys who are going into the market and really, executing on value add, and now they've switched to development, which, some people might think differently, but to me, that just says, hey, you know what, we're going to take what the market gives us, right? And we're going to be good stewards of capital. And although we've had a specific thesis, we are great real estate asset managers, and we think we can get our investors a better return by taking a little bit of that development risk. And I don't know, to me, I always love that. I just always like, the asset managers say, you know what, we're going to take what the asset managers give us.
Yeah, I think, I've seen people, in that vein, right? You either master one little niche and every variable in that niche, and that's all you do, right? Which is fine. Or to your point, and it reminds me, from my days of playing music, the best musicians are the ones that can go from genre to genre to genre, and still perform at the highest caliber, right? And hate him or love him, John Mayer's a great example. The guy plays country and funk and blues and rock and pop, whatever. So a good operator is the same thing. They can pivot and move, to your point, in a market that, if you look at the syndication models of apartments have been compressed for a long time. They pivoted to a more lucrative model. So they're clearly an experienced operator that can do that, which is good for them.
What do you think? I'm curious to hear what your thoughts, with those rising cost of debt. What do you think this is going to do for those managers who aren't pivoting? I mean, are they just going to be, how do those spreads actually work to where it's profitable for investors, unless they're forecasting very similar wild rent growth that we're not going to see? I mean, when I was evaluating and continue to evaluate a lot of these value add opportunities, you're seeing this rent growth that's so wild that the comps that they're including on the PPM, they're not even accurate, and nothing against the actual developer who's seeking the capital. The numbers were off because rents were up. When I went and did the due diligence, I found that the comps weren't even keeping in track of real time, because perhaps they're, 30, 60, 90 days old. So if you're forecasting like that, and your cost of debt is so high, and now perhaps, the prices have come down a little bit, but how does that developer perhaps who isn't able to pivot, how are they able to turn a profit?
I think you just threw me a softball, just maybe somewhat intentional, but I think you actually sent me the video. Ivy Zellman about 9 to 12 months ago called it that her biggest risk in the market that she saw was the syndications that relied heavily on refinance cap rates, right? So we know that was a risk. They've been able to live through it, to your point, because of the increase in rents. So good for them. That's starting to slow down now and plateau. So now this is where I think the chickens come home to roost. As the rates keep going up and the refinance continues to squeeze on the bottom of the cost and rents are flat, that's when you're going to start seeing these syndicators upside down on their projects. Right now, I think they're still okay because of that rent increase, but debt's chasing them quickly, and it's right on the tail.
Here's kind of what I think might happen. Here's a scenario. I always like to try and prognosticate. And one of the things that I potentially see here, developers who perhaps had really thin margins to begin with, just hoping for rates to, remain low so they can recapitalize and pay back those investors, or we see those continued rate growths, and we potentially may still see them. I don't know if we're going to see them as high. I really just don't know. But I think at some point, there's this equilibrium, and the elasticity of real estate and rent will potentially get to a similar spot. The question then becomes, you could potentially hold the asset longer, right, and continue to clip. But the incentive probably isn't there, because most of the time, the developer is going to make their money on the sell, right? So there may not be incentive for them to hold the asset. And then the LPs, the way that they were sold the deal was that perhaps it was a 3 to 5 year hold. And the reality is now they might need to be illiquid longer. And so, if we get into this environment where things may get a little crazy, right now there's a 70% chance of a recession for 2023. I think, it's happening. I think it has happened. We're just not fully seeing it yet, but it's here. Oh, yeah. And, people, when we think about a recession, it's not like our day-to-day life is going to change, but, there are people on certain ends of the spectrum are going to feel it more. And the question then becomes, if LPs start to feel it and they need their money, that's typically what happens, right? This is what kind of exacerbates these economic climates that we're in. If we get into a recession and everybody starts feeling it, then I need my money. I need my money because I'm out of a job. I need my money because I need to pay the bills. And I don't care what it's worth, because it doesn't matter. I need it now.
Well, and so in theory, this is why the PPM 506B SEC regulations exist, so that investors don't have that sort of pinch. But you're right, it always happens. And I have investors in my deals that have come to the table with that. Not very many, but a couple, right? Without a doubt, and to your point, time horizons have now gone further down the road. You're not going to want to exit next year. No, and if you do, then you're just a foolish investor. You're going to want to wait now. And again, a year ago, I think we were doing this podcast, or maybe it was a different podcast. I was encouraging people to get out of syndication 6 to 8 months ago, if they needed cash, or if they're going to exit next year. And we're now at a point where if you're exiting next year, man, I would be really concerned. So you're better off just pushing it down the road to 2024, And that MOIC of maybe it was 20% per year, getting you to that, whatever that multiple was, maybe it goes down to 16 or 14%.
Yeah, I mean, I've seen the MOICs at, probably 1.5, anywhere.
Yep.
1.5 to 2 is what I typically see in, the overall MOIC,
Like what,
right?
3-4
Not
years?
an annualized basis, but
Right.
overall,
So,
is what I traditionally see.
is that a 3 or 4 year clip?
Yeah, I mean, what I've seen is, typical 3 to 5 year,
Yeah,
3 to
so you're
5
looking
years
at-
is what I've seen. But yeah, to me, short-term money seems more appealing, kind of these, similar to what you guys are doing at Red Oak. We've seen BV Capital here on here as well, where they've got, these 12 to 15 month land development deals. They're cheaper for you and cost less capital for you to go out and do that through a syndication. And then the LPs, they're not able to get, a 12 or 15% or 20% IRR on an annualized basis anywhere else. And, if I can get that short-term money, I'll take that and just continue to reinvest it. That the illiquidity premia is, I would rather have those short-term investments at this stage of the game.
What we're doing now, and our MOIC roughly is 1.6 to 2.1, depending on the project, right? But not many investors, to your point, want the liquidity. So now what we're doing is we're saying, hey, there's also a bucket of funds that are essentially short-term financing, right? So as we're raising capital, we can say, close a deal, 12 to 14% annualized returns, you get your money back in 6 months, right? So people are looking for quick liquidity options like that. There's nowhere to put it right now. You lower your risk on the liquidity side. You're not stuck in a deal for 3 or 4 years. And then, so we're seeing a lot of traction in that department now versus the traditional equity.
And I really like that short-term development, the optionality that those present. Obviously, the developer wants it to get it shovel ready. And then you've got the optionality like yourself to say, you know what, let's continue on to phase 1, or we've got shovel ready to sell these tracts to other developers who may not want to bear the brunt of going through that entire development process. So, for an organization like you guys who have the in-house development engineering teams, you guys can go out and do this all day. Obviously, the investor risk is going to be on perhaps some extension risk, but I actually think the extension risk poses a really nice benefit because I'm going to be able to clip a pretty nice, healthy rate of return for a little bit longer. And the developer is, somebody like a Red Oak, you guys are incentivized to pay that off. You don't want that to be, extended out.
Yep. Takes one bad deal and it's all over.
So, well, with that, man, I always learn a ton on these things, which is kind of the intent. This has been a hobby of mine to really kind of, pick your brain, pick guys like Daniel, and really understand and learn a little bit more than I did before this call. And that was the intent. Hopefully the folks that listen are getting the same, same benefit as we are, and perhaps not real time because we've got a little post-production, but nonetheless, we thank you so much for listening. We hope you learned something. If there's ever a need, please reach out to Tom or myself. I can be found at mflax@netequitycapital.com. Tom, where can folks find you?
Tom at redoakvc.com.
Very difficult. Always good to hang. I look forward to having a beer in person tomorrow.
Yes, sir.
Thanks for listening.